Without objection, your written statements will be part of our record. Mr. Brooks, we'll start with you. You're recognized for 5 minutes.
Well, Mr. Chairman, Ranking Member Waters, and members of the committee, thanks for having me today. It's great to see many of you again. Most Americans know, as you said, Mr. Chairman, that everything got more expensive over the past 5 years as the country experienced the highest inflation since the 1970s. And house price inflation was dramatically worse than inflation as a whole. Between 1991 and 2025, U.S. home prices increased at literally twice the rate of background inflation. And prices of houses are compounded by high prices for credit. Interest rates remain persistently high, and regulatory pressures have reduced credit supply to a point that is almost as significant as the problem of housing supply itself. So today I'll focus on several specific dimensions of this problem. First, let me start by addressing the housing supply deficit. We are about 5 million units short of what would be required to support total housing demand in this country. And one reason is the magical thinking of rent control. I live in Los Angeles, where I recently saw a building on the side of a billboard on the side of a decrepit building that literally says, rent control, an LA tradition since 1919. And LA's housing cost has been one of the highest in the nation almost that entire time. Is this in spite of rent control, or is it because of it? In some cities with rent control laws, such as New York, where my company is headquartered, regardless of a building's operating expenses and maintenance or repair needs, not only are annual rent increases capped for existing tenants, but the rent can't even be increased when an old tenant moves out and a new tenant moves in. As a result, building owners, including many of my firm's clients, can predict with incredible accuracy the day on which the expenses of the building will exceed the building's income. And on that day, there is no further capital available to perform necessary maintenance, meaning that small deferred repairs turn into major structural problems. And as we learned in 1970s New York, the building then fails, it's taken over by either the bank or the city, and the disaster becomes a taxpayer problem without any tenants being any better off. Rent control deters investors from building new housing units because they can't recoup their investment. So rents rise in those cities due to shortages, while rents are stable or even falling in places without rent control laws, places like Austin, Dallas, Denver, Phoenix, which have experienced building booms. Then there are the local environmental, permitting, climate mandate, zoning rules. I mentioned again, I live in Los Angeles, about 5 miles from the Eaton Fire burn zone that destroyed almost 7,000 structures. More than a full year after that devastation, construction has begun on only about 7% of those burned out properties, and even fewer in the Palisades fire area. LA's complicated overlapping rules on an array of environmental, fair housing, energy efficiency, and similar issues may not explain all of that slow-rolling tragedy, but it's undeniable it's a significant part of it. The federal government can actually address all of this. Some of what this committee passed in the Housing for the 21st Century Act is a great start, but there's more. The Housing and Urban Development Department distributes tens of billions of dollars in state and local grants. Those funds require a finding that local policies promote the construction and availability of housing. HUD could declare that some of these rent control and permitting ordinances in fact reduce the construction and availability of housing and refuse to subsidize states that pursue these policies. HUD also has the power under Section 8 and various other statutory provisions to revoke approval or withhold funding to localities that pursue policies that reduce the supply of housing. HUD could further consider preempting state and local rent control, environmental review, climate change, and other anti-housing laws to the extent that they would apply to HUD-insured mortgages. The affordability situation, especially in our blue coastal cities, is dire enough that all of these options have to be considered at this point. Now, let's talk for a moment about federal banking policy, something that all of us know well. Since President Obama signed the Dodd-Frank Act in 2010 and accelerating during the last administration, federal banking policy has sharply reduced banks' role in housing finance. Non-banks currently originate the large majority of all mortgages, and those loans that are made by banks usually wind up on the government balance sheets of Fannie Mae, Freddie Mac, Ginnie Mae, or the VA. At this point, only about 10% of mortgage credit risk is actually borne by the private sector. Dodd-Frank is partly to blame since it imposed a series of rules that disincentivized mortgage lending as a banking line of business, but separately, bank supervision, including by my old agency, the OCC, led banks to be very wary of lending to apartment owners and developers. Time and again, those of you who speak to community banks will hear the story of how over the last 5 years, the OCC, the FDIC, and the Federal Reserve have gone into banks and have declared that performing loans that have never had a payment default should nonetheless be charged off in an effort to make sure that they're not embarrassed by another Silicon Valley bank failure again. And that overcorrection has drawn community banks out of the sector, forcing the federal government to deal with the situation. In my written testimony, I talk about a couple of other topics, which I encourage you to talk about today, including Fannie Mae and Freddie Mac and their future. I appreciate the committee's time. Thanks so much.
Mr. Chairman, Mr. Brooks, welcome back to the committee. I think the testimony that you offered about the nexus between federal bank policy, overregulation of the banking sector, and affordable housing is very timely. As you know, Chairman Hill and I introduced the Main Street Act to right-size regulation so that especially our community banks can focus on the housing market and help Americans achieve the goal of home ownership. Your point that non-banks currently originate the large majority of all mortgages while banks originate the remainder, most of those loans wind up on government-related balance sheets with only about 10% of mortgage credit risk borne by the private sector, I think is a very important point. You highlight two causes. First, Dodd-Frank's disincentivizing mortgage lending, and then second, bank supervision, leading banks to be wary of lending to apartment owners and developers, and the negative signal that sends. How might the Main Street Act that we've proposed help solve these problems and enhance community banks, in particular, their ability to help Americans achieve the American dream of home ownership?
Well, Mr. Barr, thank you for the question. It's great to see you again, and thanks for your leadership on that bill in particular. It's a great idea. I would argue the most important idea of the package that the committee's looking at. And I say that because community banks are so much better credit managers of these kinds of loans than are Fannie Mae and Freddie Mac. And why? Because they live in the local community where they know the asset, they know the borrower, they know the history of the asset. I think about Mr. Huizenga's story about his small apartment building in Michigan, right, where the local bank that knew him well was not allowed to invest in that loan, and instead it got shipped off to some bank someplace else that wouldn't know it as well. So first of all, an enormous amount of deployable capital sits in banks below $10 billion, which is what you're focusing on in this Main Street Act.
And nothing wrong with non-bank.
So, Mr. Brooks, first, can you expand on how the rise in housing costs affects small businesses, Main Street America?
Well, as several witnesses have already said, Congressman, the foundation of most households' wealth is their equity in their house. And so the ability of a household to spend, the ability of a household to sell the house and move for a better labor opportunity, it's all really tied up in the robustness of the housing market. And as I said, the robustness of the housing market has two aspects to it. There is the price of the house and your ability to sell it. So we saw in the financial crisis that labor mobility went to zero because no one had equity and they couldn't sell their houses. And the second piece is the price of credit, which is how much does it cost me every month to pay my mortgage and stay in that house. Both of those things are inflated right now, which contravenes what you learned in economics class in high school. Usually if the cost of money is high, then the cost of the underlying asset is low. Right now we have a strange stagflation in the housing market. Something's got to be done about it. This is the Committee on Financial Services, and so you have jurisdiction to oversee the credit allocation in this country. And I would argue that the regulation of our banking sector, the reduction in competition in lending to Main Street, right, where people can use home equity to fund businesses or sell houses to move for better jobs, that system's broken. It used to work well. It stopped working after the crisis.
You're exactly right. So, Mr. Brooks, let me shorten my question as we end it down here. What are the consequences for borrowers in local economies when community banks, which bank people like me, are forced to pull back in lending due to regulatory capital, and we just talked about that, pressures?
Well, Congressman, one of the things that happens is foregone consumption because most people don't have access to Goldman Sachs. So if First National Bank of my hometown in Colorado isn't going to make the loan's not going to get made, is the bottom line. Most capital formation happens locally, and if community banks are not unleashed to supply that demand, you're mostly out of luck.
Well,
a lot of people don't know that housing inflation was dramatically worse. Can you talk about why we saw that spike in housing inflation?
Yeah, so Mr. Loudermilk, one of the worst parts of that problem is the 5 million unit housing deficit is not new. The 5 million unit housing deficit goes back basically to the immediate post-financial crisis era, and nobody's built a house since is almost what it feels like, okay? And that was the point where two things happened at the same time. So one is we had bad credit management, which meant many people had negative equity in their houses and couldn't move for work and couldn't sell their houses. And the other is we overcorrected on the credit side. And I would argue that a corrective was needed. We needed something like Dodd-Frank. But with 15 years of experience of that kind of regulatory environment, banks can't do business. We could talk about it in the housing context, as we've already done, but Mr. O'Leary's mentioned factoring and inventory finance for a while. The federal bank regulators have more or less prohibited factoring as a business line for banks. Venture debt doesn't exist in the United States after Silicon Valley Bank failed. These are all overcorrections where there's a strong demand for a product, and when you drive the regulated institutions out, what you're left with is the hard money lenders and the scary guys nobody wants to talk about. That's got to be fixed.
Well, we're addicted. This institution is sort of like when somebody has a headache, they go to the doctor, they give them an aspirin, and they never look to the real root of the problem, and our aspirin is money. Just throw money at something and hope it goes away, but it inevitably gets worse. Would additional government spending instead of meaningful regulation relief and market-driven reforms make housing availability and affordability, would those problems get worse or better?
Let me just say, the more regulation that has come into the housing markets, the more, it's like you squeeze a balloon. So you think you're solving one problem and it pops up someplace else. As government gets involved in credit allocation, what winds up happening is market discipline goes away. So think about what Fannie Mae and Freddie Mac were doing in the 90s. They were inflating markets in areas and creating loans for people who couldn't afford the loans, leading to a very predictable foreclosure crisis. That's what happens when government, rather than private sector actors, start managing credit, is they allocate the credit to their friends. This side has their friends, that side has their friends, but squeezing the balloon is never a good idea. The good idea is let the shareholders bear the risk. Let the private sector get back involved here. You know, private sector banks can manage credit just as well and fail if they fail, just as well as a car dealership can, just as well as anything else can. But when government's too involved, bad things happen.
Real quickly, I'm running out of time. I've got a bill called the Taylor Act, which would cause government agencies to tailor their regulations based on the risk of the business, the size of the business, the scope of the business, instead of just blanket regulations. How important is that?
Critical. Compliance for compliance sake is a waste of time. You have compliance because there's a risk. So say what it is and control that risk.
And with that, Mr. Chairman, I'm out.
Mr. Brooks, we don't have many seconds left here, but what can we do? What do you think Congress, policymakers here can do to reverse the damage done by the Biden-era inflation? Is there something we can do from a policy perspective?
Well, you can start by fixing the regulatory overhang. So somebody said earlier today, you've got two problems, inflation and taxes on one hand and regulation on the other hand. Growth requires deregulation. We have to grow our way out of this.
We've gone from roughly 14,000 banks in the 1900s to 4,200 banks today. I'd like to hear your opinion on how much of that decline in the banking industry is due to over-regulation versus normal market conditions. Because sometimes we say we're capitalists, but I don't know if I really like the free market. So I'd like your opinion on that.
Well, I appreciate the question, Congresswoman. Mergers and consolidation usually happen when you need to spread your cost across a larger asset base, right? And so if compliance and other non-productive activities, and when I say non-productive, I mean non-revenue producing activities, become a major burden, you have to put them inside of a larger institution so that you have the revenue base to support the compliance. So there's no question that's one of the factors that's led to the shrinkage in banking. The other thing as a side point that's led to the shrinking in the number of banks, of course, is that at some point we stopped chartering new banks. We went about 15 years post-financial crisis where we chartered one bank or zero banks a year at the federal level. Previously, the number was in the double digits every single year. Compliance is a huge burden. It really is. And the point of the Main Street Act, and one of the reasons I applaud it so much, is because small banks don't have the kind of complex operations, and they typically don't support the kind of systemic, risks that JP Morgan does. And so holding them the same set of stress testing environments, which are obviously different for small banks, but those kinds of things for small banks really don't make sense.
Appreciate that. Second is you've said, and I thought this was very interesting, the Dodd-Frank made compliance so big and so expensive, that it's too small for banks to succeed. I thought that was a really interesting quote. Can you elaborate on that?
Well, I mean, what Dodd-Frank...
I'm sorry, we've always heard, oh my gosh, it's too big to fail, but too small to succeed, I think is
Yeah, it's 100% true. So what Dodd-Frank did is, and I think some of this was unintentional and some of it was just an overcorrection in a crisis, right? But now we have history, so we know what was good and what was bad about it. Dodd-Frank almost singled out housing finance for negative treatment compared to almost everything else. And the reason we did that is because of this belief somehow that the financial crisis was exclusively a mortgage crisis. And the idea was, well, we have these long-dated mortgages and these short-dated deposits, and that mismatch creates inherent risk. So you have to hold enormous capital against your mortgage book. And if you're a small bank, if you're a sub $1 billion, let's say, community bank on Main Street, USA, like in my hometown, you can't hold that kind of capital.
It's just not feasible.
Right. And so what happened? What happened is all of those loans got sold to Fannie Mae and Freddie Mac, and banks no longer held any credit risk.
I appreciate it.